Hello, guys. It's me, Casper again. As mentioned on Twitter, I have a very special guest today. You may know him, you may not, but it's Andy from Finding Value Finance. Um, this is his Twitter page. I highly recommend you going to follow him. I've been following Andy for like 2 years, maybe even a bit more. Uh, Good value, so please subscribe. Same for his YouTube channel. He posts daily with very good content. So yeah, please follow Andy on these two. And hey, Andy, how are you doing today?
I'm doing fine. Thanks for having me on, Casper. Really appreciate it.
Yeah,
And
it,
I know you've been on my channel half dozen times. So obviously, thanks for coming on my channel too. And now we're reversed, roles reversed. You're
yeah, exactly.
the host
Yeah,
and I'm the
it's a,
guest.
I can feel it's a bit more difficult, but I think we can manage it.
Hmm.
So yeah. So Andy, we've been talking back and forth on your channel about commodities. That's obviously our big, what do you want to call it, what we are very into right now, especially in this decade. Um, so let's just dive right into it. Um, I
Hmm.
know for the fact that you are still still a very big oil bull. Me too, by the way. But we have been in a big correction here for the past year or two. But please give me your take on oil. Where do you think we'll be in the next 2, 3, 5 years? What do you see in your crystal ball?
Yeah, so I think well, first I'll say this, the commodity bull markets that we've seen in the past, just in general, so you guys kind of know my general overarching paradigm or thought process is um, credit expansion into the system puts everything into a shortage. It increases interest rates with that credit expansion. And the credit expansion comes from the real estate market. When that comes into existence, it puts everything into a shortage for these periods of time where there's a larger demographic coming into home buying years. And those interest rates cause money to rotate differently within the
Hmm.
system. So when you talk about oil, that credit comes into the system, it puts everything into a shortage, and oil is the most sensitive commodity to that credit expansion. So oil is very sensitive to credit growth. It is one of the most inflation sensitive assets in the world. So when I look at oil and I look at the future, I am in the camp that we are going to continue to have inflation for a while. And I think oil is going to do incredibly well in the future because of that tailwind of credit expansion and the demographic. We also have, in my opinion, some supply side problems with oil,
Yeah.
which is going to exacerbate that credit expansion growth. So when I look out, you know, 5 to 10 years, somewhere in that range is probably where we're going to peak. I see oil going way higher than where it is today. Today, I can't even believe where we're at today at $72.67. That's kind of amazing that we're this low at this point. I would guess 80, $90 at a low point is what my best guess would have been
Mhm.
for a pullback from 120. But it's pulled back a little bit more than what I thought.
Do you think?
Uh, this, what's that?
Do you think this deeper pullback that I didn't think we would go that low as well, but do you think it could be due to the SPR releases that the US has done for the past
Yeah,
1 year? Yeah.
I think it's partially due to that, and I also think that the cycle the cycle was going to bring it down to some extent.
Yeah.
I think it was exacerbated to the downside a little bit through some of these releases. Um, and when I look at this and you look at it from a long term perspective, we're I think we're going way higher, but that's
Yeah.
my take. To levels that I think most people would say it's ridiculous. And all I'm using to replicate, if I were to throw out a number, I think that oil is going to go down on a gold to oil ratio down to like 7 or below. somewhere in that range at the peak. So if you were to do the number or do the math, at current prices, just use like $2,000 gold, make it a little bit easier. You're talking like over $300 a barrel oil.
Yeah. Okay.
And if we go higher in gold and the supply problem, for whatever reason, people start to panic, that I think is like kind of the lower end. We could see a spike that goes higher than that. And I know that seems kind of a very high estimate, but I think over that time frame, depending on how much money they create, depending on where gold goes, that could even be a low estimate.
Yeah.
It just depends what the dollar's value is at that point.
Yeah, correct.
So what I'm basing this off of is I think that we're in a cycle much like the 2000 to 2008, which was a commodity bull market. That was driven off of credit expansion in the system with the housing market boom. But I think that we also have some supply side issues, which could be much like the 1970s. And the 1970s was the end of a credit expansion phase because it started in the 40s. And it went up with a larger demographic coming into home buying years through that 40s, 50s, 60s, 70s period. Housing starts went to an entirely new level in the 70s. I don't know if we're going to go to an entirely new level like the 1970s from the credit expansion side, but we do have credit cycle that's getting towards the end of it, and we could be seeing a lot more money creation from interest payments on the debt.
Yeah.
So that's an interesting setup there as well. I think it's going to be favorable for a bunch of different commodities, but oil is one of my favorite, and I can explain why oil is one of my favorite. It's the most sensitive to inflation, but two, I think there's a lot of good vehicles to play oil with. Uranium, on the other hand, I'll just bring in uranium a little bit because I know we like uranium a lot.
Yeah.
Uranium's in a similar situation as oil in terms of its value, in terms of it being energy and inflation sensitive and all that stuff. It's just, how do you play it? There's just not a lot of good ways to play it because a lot of the companies they don't have cash flow.
No.
The oil companies, they're cash flow rich, baby. They got cash. They're oozing cash.
Yeah, they are.
And they're cheap right now in relationship to the price of oil, and they're cheap in relationship to their cash flow yields. So I think, looking at the companies in this sector, they're the most attractive to me based off of where I think oil is going to go, where the gold to oil ratio is, and the pricing of a lot of the vehicles to play it are cheap with whatever measurement you want to measure it by. You can measure it against oil, you can measure it against free cash flow growth, you can measure it against the reserves, PDP reserves. There's so many undervalued metrics that there is in oil. So that's why oil is my largest holding, I should say, from a percentage basis in the equities portfolios. And I think oil is going to go 250, 350, 500. I don't know, wherever it's going to peak out at. You guys can put your guess in the comments section. It's probably going to be my guess anyway.
Yeah.
I'm not here to make predictions or guesses.
No. But I think if we can pull it up just quickly here, but if you look at the oil chart on the log scale, I mean, that will
right here. I had it pulled up already.
Yeah. And if you look at the long-term 50-year on a log scale, you can actually see, a case for what you're saying. So I think is it log scale? Yeah, it is.
Yeah, it's log. And we had a consolidation period through here. This was the beginning of the bull market to the end of the bull market. I put a little circle there. And we've got another new beginning of a bull market at the bottom of 2020.
Yeah.
And we punched through this consolidation zone. And what's cool is we're basically doing a retest right on top of that trend line.
Yeah, that's nice. That's very nice.
And I think even right where we're at, I think it's a pretty good spot to be looking. along with where the companies are at too. And
Yeah.
it's very rare to get these alignments where, like right now, we're at 26, 27 barrels of oil to 1 ounce of gold, which is extremely cheap for oil. That would be, let me yank that up here real quick.
Yeah, sure.
There's gold to oil ratio. We're at 26.7. And we've got these wicks at the top as
Yeah.
well. It's cheap. And if you're looking, if you want to invest in oil and you want to follow the markets, what a lot of people do is they follow the inventories. And right now, we're at an interesting kind of point where the paper market is disconnected from the physical market.
For sure.
And the physical market is seeing a lot of tightness. We're seeing inventories draw down. I know some people, Jeffrey Curry, Goldman Sachs, he's the head of commodities there.
Yeah.
He calls it destocking. And basically, you're just drawing down your inventory levels. What happens in these markets where before you get like a gigantic move in price, it also happened in the housing market, the real estate market, is prices are low, demand goes up, and you start to create a deficit, which eats through inventories. We were getting deficits since 2020, and we were started eating through a bunch of inventory. And ever since then, we've been eating through greater and greater amounts of inventory. And that's where they released the strategic petroleum reserves. They've been eating through some of these tankers that they've got in Iran and all these other areas where they just start kind of releasing everything out of inventory. That's where Jeffrey says it's the destocking. And I agree with him. So what's going to happen is if the deficits still continue, we still eat through all these inventory levels, I think that we are going to get in a very tight market, probably this year, later this year, or something like that.
Yeah, I agree. I agree.
And we're going to see prices start to move. We're also sitting, like you said on the logarithmic chart, we're sitting on top of a trend line, a support line. So if you're sitting on top of it and we're running deficits in the physical market, the paper market just dumped all of its longs basically onto the market because they think a recession is potentially coming.
True.
And I can tell you, I don't know if a recession is going to come. I'm not in the game of predicting, but if I were to predict something, or if I were to position on an idea, or an idea that I've got is, I think people have already priced the recession in, and I don't think they're pricing the physical tightness.
No.
So I think the path of least resistance is higher for the price of oil for the rest of this year. Doesn't mean it's going to happen immediately, but I think it's going to go. The path of least resistance is up, and with the companies where they're at valuation wise, I see it as a pretty good spot to be looking.
Yeah, I completely agree. I think we are also closer to the bottom than we are to the top for sure. Could we drop, let's say $10, $15 in the short term? Absolutely, maybe even more. But as you were saying, if you're looking for a decade-long play, I think oil, you should look into that for sure and find some good spots to play it. Because me too, I think it will go way higher than we are currently. As you mentioned, it will not happen tomorrow, maybe not this year, but I agree. I totally agree on that case. Because we haven't solved anything right with the energy, so it's just it's just a pause, before we go higher, in my opinion. So
yeah, we can talk natural gas too if you'd like.
yeah, sure. That's
so natural gas, that's my favorite commodity. It's my favorite because they call it the widowmaker, which
yeah,
if you get it wrong, it can really burn you. And it's also not as predictable because it's very weather dependent. Weather being hot weather, which they draw down inventories to generate electricity when people turn on air conditioning and stuff like that, and cold weather for heating fuel. And this past winter, we were definitely not as cold as normal in Europe.
No.
So
no.
The inventory levels didn't really draw down very much. But here's the thing that I think people are forgetting about natural gas. Natural gas, we don't have the flow rates in Europe anymore. Nope. And what I mean by flow rates, basically Russia is like, they're done.
Yeah, they are done.
They're
Yeah, for
done
sure.
sending natural gas. It's over with. So your flow rates are, they're not nearly as high, the capacity to flow natural gas. So Europe is much more susceptible, certain portions of Europe is much more susceptible to weather related events. So if it gets really cold, they can blow through their inventory and they can't make up that inventory due to the flow rate. And that's where I think a lot of people, they tend to forget that. They go back to a normalcy bias. They look at the inventory and they say, oh, the inventory is at 85% or 80%. We're not going to have a problem. It's like, well, if you get cold, you're going to blow through that inventory,
And you
and
can't
all of a
refill.
sudden
Yeah.
people are going to panic.
Mm.
So I think natural gas, it is weather related. We don't know what the weather is necessarily going to be this winter or this summer even, but I do think we could see some huge volatility out of natural gas. And if you're a patient investor, you can kind of get when it's cheap, and it's cheap right now. It is very cheap right now. And if you're very patient, and I'm not talking about playing the commodity itself, you can get some of these natural gas companies that have pulled back quite a bit. They're paying some dividends, and it's like, yeah, I can just sit in these and wait for the price to go back up to some, higher level than where it is today. We're at like $2 and something
$2.
cents
Yeah.
right now.
So, yeah.
It is cheap. And when you look at the natural gas to crude oil ratio, can yank that up too.
Sure.
Let me see which one it is. There it is.
Also, I think the average, bottom for natural gas is around $2 if you look back like 50 years or so. So $2 is like
Yep.
the lows, and then from there it just sits before it spikes. So yeah.
Yeah, and you can see there's been areas where you've had low ratios, and then you've had an area where we were in a bear market for high ratios. I do think with time that this is going to work its way back down underneath the average of about 12, get underneath the average and stay below the average for a while. We had a massive anomaly here where it got all the way down to 2.8, but
Yeah.
If we were to go from 40-ish, or we're at 30-ish right now, 30 down to, 6 is the energy equivalent of natural gas to oil. It's 1 to 6, 1 barrel to 6 million cubic foot, or MMBTU.
Yep.
We've got a massive move in natural gas that could occur. Now, I'm not saying it will occur. I'm just saying it could occur. So what I look for in the markets is I look for these imbalances in the ratios where something gets incredibly cheap. I start buying the equities, not necessarily natural gas itself, and then I just sit in it and wait.
Yeah.
I know some people, they try trading the short term, but I just get in, I kind of cost average in, I just wait on it. And with the ratio this cheap, I mean, guys, all it takes is one bad weather related event.
Yeah, true.
And we're going to go back up to like 10, 12, $20 a million cubic foot, somewhere in that range is where it could spike. And with the equity, on the equity side, that could mean huge moves.
Yeah, that's many multiples of the move for gas for sure, if that were to happen.
Mhm.
And as mentioned, it only takes one panic button, right? Just need to panic one time, and then everything goes crazy, just like it did last time here in Europe, at least.
Mhm.
So yeah, I totally agree.
Yeah, I
Totally
like
agree.
natural gas just because of the volatility it has, and you can
Yeah,
make a lot of money on it
yeah,
if
you can.
you can time it somewhat right.
Yeah, true. But yeah, I think it's just this past 2 years has just been one big pause before we go higher. Could it take one more year? Sure, it can.
Mhm.
But yeah, we haven't solved anything. So I agree. I totally agree. Energy will be a leader once again, for sure. I totally agree. Let's just go
We
quickly
could.
to platinum, because I think I can we only have 5 minutes left here, I can see. So let's quickly do platinum, because I know platinum is your baby boy. So what do you think on platinum? I know the supply side is very short, very short if you look at inventories. And also the chart just looks absolutely amazing. So yeah.
Yeah, platinum is the cheapest metal on a ratio perspective when priced against any other asset. Generally, when that occurs, whatever metal it is, we've gotten gigantic outperformances of that metal.
Yeah.
So we saw that in palladium in 2009, early or late 2000s. So 2009, palladium was in that same situation. It was around $200-ish, went all the way up to almost $3,000.
Yeah.
And this is just a hunk of metal. We've got silver, which is also very attractive in terms of its ratio against gold, but platinum, it's cheap to silver as well.
Yeah, it is.
So platinum, speaking of the demand supply side, it changes very rapidly with platinum because it's very hard to predict if it's going to be in a surplus or a deficit. And what I noticed is that they were projecting surpluses just like a year ago.
Oh, really?
And everyone's like, oh, there's going to be a surplus. I should sell out of my metal. What should I do? And it's like, guys, it's the cheapest from a ratio perspective, which means engineers like Casper and myself are going to try to design in platinum over palladium and other materials if it's the cheapest.
Yeah, sure.
So eventually you will get a rotation into platinum versus other metals if it stays at these levels of cheapness. But there are projected deficits in the future and occurring now, which are quite, I'll just say that they're large. The projections are 1 million. The market right now is about a 6 million on the supply side market. You've got some recycling, you've got some other stuff that tops it off to about 8 million or so a year. So it's 1 million over 6 million on production. Production's been kind of just barely holding on, going sideways, where we haven't really been going up. Platinum's also used in a variety of industrial applications that are growing rapidly. So the growth of platinum is growing rapidly, even in the industrial side, not talking catalytic converters, not talking that stuff. The actual industry that uses it for a variety of different things. So I think platinum, if you take a longer term perspective and you get in when the ratios are this cheap, you just sit in and hold on it.
Yeah, true.
That's what I did with palladium, but that took a decade, over a decade of me holding that to get that full valuation. On a risk reward basis, I think platinum is probably one of the best metals, best investments on a risk reward basis. And the reason I say that is the risk is really low when you hold a commodity. And I think there's a lot in this world that can go wrong on the producing side. 80% of platinum comes from South Africa.
Yeah.
And they've got a horrible electrical grid. So if anything happens with that electrical grid, anything, it can impact a good chunk of that production on the supply side. And I don't know where prices could go if you lose 50% of that production. I really don't know. And if you're running a million deficit and you get offline maybe 2 million ounces, now you got a 3 million deficit. And that's 50% of the entire production.
Yeah.
So I mean, if that were to occur, I don't know where prices are going to go. It's not going to be at $1,000 an ounce.
No, for sure. And also the remaining supply comes from Russia, right? Or thereabouts. So you have Africa, Russia. That's it.
Yep.
More or less. So
yeah, South Africa, I think, produces 70 to 80%, somewhere in that range. And then Russia produces like 20 to 30%, depending on how you look at it. And then there's just like small slivers of other areas.
Yeah.
So yeah, it's Russia and South Africa. And it'd be really weird if, Russia just said, we're not going to sell our palladium or platinum. And then they pull that back, and then something happens in South Africa. It's you'll have like zero, a few percent of platinum in the world that's ready to be traded around.
Yeah.
Another thing is a reason I'm so drawn to platinum, and the reason I bought palladium as well. Not a lot of people own this, which is a good and a bad thing. It's good that people can't just sell this stuff into the market because no one owns it. So it's a very, very scarce metal, and not a lot of people own it. And you're not going to have this big dump onto the market like you would with silver or gold, where a lot of individuals hold that. It's more driven by industry, and we've seen gigantic moves in platinum group metals over the years. Palladium's gone 200 to 3,000, and we had rhodium that just went ballistic.
Rhodium, yeah.
650 all the way to almost $30,000 from 2016 to 2020 or 2021, somewhere in that range. So I think platinum, you know, I don't expect it to go to some ridiculous level, but it could.
Yeah, it could.
So
I mean,
I just hold on to it.
yeah, me too.
It's a form of wealth preservation
Yeah, and I
for
think
me.
I've mentioned on your channel as well. I think, you know, personally, I have a target of this 6-7K ish in that area.
Mhm.
So anything, you know, 5K, 6K, 7K, or a bit higher wouldn't surprise me at all for this for this decade. So
Yeah, but I also think if something were to happen on the supply
oh
side,
yes, oh
it
yes,
it could just go ballistic
I totally
on
agree.
all the metals that
Yeah,
are platinum group metals.
yeah, I agree.
Yep.
So yeah,
So yeah.
so just let me just cut it here, Andy. I will stop this video, then we will do part 2, and then we'll just look into gold and just a little bit of uranium, because then we have covered the entire energy sector, and then we will finish off with gold and silver. So stay tuned, guys. We will be back.